For more on what we can expect from the central bank, let's bring in critic of QE2 and Fed Chief Ben Bernanke, Jim Grant, founder and publisher of Grant's Interest Rate Observer, widely read letter here. Jim, welcome back to InBusiness.
Thank you, Margaret.
What are you expecting today?
Just what Peter said.
A whole lot of nothing.
Well, what I would like to hear, what we will certainly not hear, is a concession that QE2 has achieved its unintended consequences, namely a lower dollar exchange rate, maybe that was intended, higher gold price, meaning weaker confidence in the dollar, slower economic growth, and a higher measured rate of inflation. Those are some of the things that has come out of this experiment, and let us call it by its name, money printing. I think he will not say that, but I will suggest here that he should.
And that's what you consider QE2 to be. The other thing many point out it accomplished was helping to restore some confidence, or at least gains, in the stock market. But what did $600 billion worth of bond buying get us?
Well, the Fed has two remits. It's meant to promote full employment and stable prices. This business about levitating stock prices is something new, and I think it's a quite dangerous thing. How do we know that this 30% gain in the Russell, the 20% gain in the Dow since the chairman spoke in August of last year? How are we to know these are real values? The prices are up, but are people who are buying these stocks on the back of the Fed, are they doing something that's wise and considered from an investment point of view? And if the market is too high because the Fed has put it there, what does the Fed do when the market comes down, which I think opens the gate for QE3.
Wow. When you were on this show in July of last year, you told us you expected the Fed chief to use Jackson Hole as a platform to indicate QE2 was on its way. He did that. Do you expect us to hear at Jackson Hole QE3 if we don't hear it today?
No, but I think the cue for a new round of money printing would be weakness in one of these asset markets, so-called, meaning the stock market especially. Under the lash of all this money printing, corporate bond prices have rallied, corporate equities have rallied, of course. It feels great. But the Fed is embarking on something new and I think highly questionable, which is to enforce the symptoms of prosperity rather than sound money. And prosperity used to be a co-product or a byproduct of sound money. Now the Fed is trying to impose prosperity by lifting up the prices of stocks and bonds. It seems to me that's the cart before the horse. How about an economy that is sound, generating good job growth, generating good incomes, and on the back of that, stock prices go up? And it seems to me that the Fed is pushing up prices, and therefore either it owns the stock market or the stock market owns the Fed.
You don't think that's manufacturing confidence along with those gains?
It's manufacturing a kind of confidence as long as the market's going up. When the big arrow goes down, the confidence vanishes.
And you've been a fierce critic of the Fed here.
A fair critic, Mark.
A fair one, you could say, but a fierce one. The Fed would say, hey, what's not fair is you're not giving us credit for preventing deflation. You're not giving us credit for corporate profits growing since we, unleashed QE2.
Well, deflation is the great point of confusion. The Fed defines deflation as the Walmart business model. By deflation, it means everyday low and lower prices. Most Americans spend much of the weekend seeking out exactly that peril. And the Fed would do us all a great favor if it would try to distinguish between progress, which is what some of us call cheaper production costs and lower prices on the one hand, and deflation on the other. I think that by seeking to scotch this so-called peril deflation, the Fed is actually instigating huge financial instability.
So you'd say, well, you accomplished that. Prices are going up, but that's not really what you should have been intending to do here. But what about corporate profits increasing the way they have? Is that just all cost cutting? You give some credit to the Fed for helping to instill stability or confidence in some way.
The Fed is not instilling confidence. The Fed, one important measure of confidence in the dollar is the price of gold. How much gold will a dollar buy? It's 1/1500th of an ounce. It's 20% less or so than when the Fed started in this program of quantitative easing. Corporate America is doing a terrific job, but it's not because the dollar is getting debased, which the dollar indeed is. So the Fed has pushed interest rates to zero, right? It has flooded the system with dollar bills. Pity the poor saver who wants to get something, some little taste of interest income on his or her balance, so that they invest in money market mutual funds. The money market mutual funds, having nothing to do in this country because rates are zero, go to Europe. So money market mutual fund investors are taking quite ponderable risks for about a 0% return. They're yielding these funds are yielding a few basis points only. But to get those few basis points, these funds are crossing the Atlantic right smack dab in the middle of the European banking crisis to try to pick up some measure of yield. This is a prime example of the unintended consequences of this massive intervention by our central bank.
You think it's increasing actual exposure or pushing people towards Europe? What is Bernanke going to say about how, Greece is really changing the trajectory of the global economy? Is it?
Well, I don't know if the Greece has changed. I think that the monetary system, as it has become, as is evolved, is the principal agent of our troubles, or much of our troubles in the world today. I mean, the Fed is we have substituted over the years, we have substituted a gold standard for that. We substituted a kind of a PhD standard. And as your West Coast tech correspondent was talking, I was listening to Corey, I was thinking, how analog is the Fed? It imposes, through a committee decision of fallible human beings, it imposes a rate on an economy in a kind of a command and control mode. It's utterly unlike anything that is animating the success of, for example, Apple. It seems to me that the Fed is living in the age of black and white TVs with rabbit ears, and the rest of us have moved on into much more sophisticated systems of communication and information flow. We're going to listen to the Fed hand down its decision on what the funds rate should be. How do they know that?
Are you more in the Jamie Dimon sort of worldview here of less regulation would be better? The Fed needs to be looking at this kind of intervention?
The federal regulators have fixated upon capital as the chief consideration of regulatory health of a bank. Long ago, banks had much more capital than they do now. The principal failure in the early years of the Great Depression in this country, Bank of the United States, had no less than 17.7% ratio of capital to equity when it failed in 1930. Capital is not the answer. Capitalism, in my opinion, in the banking system is the answer.
Jim, 2 p.m. We're going to get more insight. 12 o'clock, we'll get the decision as well from Ben Bernanke. When people look at what the Fed's mandate is, some say there's actually a third mandate in there. You mentioned the stock market support, but really support for a housing market that continues to be in decline in the U.S. Could the Fed do anything but keep rates where they are, considering they also have to keep things cheap for the banks who have these rotting assets still on their balance sheets?
Well, if I were running the Fed, Margaret, what I would say is that housing prices ought to be exactly where buyers and sellers determine housing prices should be. That would be my policy.
Decline.
Yeah, I would allow the housing market to do what it would do and to find a level at which buyers and sellers could transact, and we can move on to the next opportunity or problem. I think the difficulty with the Fed generally is that it is imposing false values across a range of markets. It has given us a 0% funds rate. It has, through this agency, levitated the stock market. It has depressed or helped to depress the value of the dollar exchange rate. It is in the business of imposing false values. My suggestion is that we learn to live in a world of transparently objective values, and for that, the Fed might just take a little rest.
Well, the fear is that you'd have some kind of credit market event out of Europe. You would get further decline in the balance sheets.
We're going to have credit market events because the Fed has suppressed risk rates. For example,
what are you forecasting?
Margaret, I'm much too old and wise to forecast anything. What I observe is that you're not getting paid to take risks across a range of markets. In the junk market, yields are pressed low against government security rates. In Asia, non-rated companies are issuing perpetual debt in dollars. People are taking risks, and people, I should mention again that in money market mutual funds, people are getting paid exactly zero for considerable risk in Europe. So we always have risk. The world is full of banana peels. That goes without saying. The difference today across a range of markets is you're not getting compensated for the risks that we face, and the Fed itself is helping to create these risks through the manipulation and the suppression of interest rates.
What grade would you give the Fed, Ben Bernanke's Fed?
On the scale of?
What's your rating system there? I mean, some would say avoiding a banana peel is enough of an A.
Look, the Fed, we have exchanged the gold standard for the PhD standard. It is a very bad trade. We ought to get rid of the PhDs and install someone who majored, a nice solid bachelor's degree person with a concentration in unintended consequences. That's my suggestion for improving the Fed. Get somebody who majored not in economics but in the law of unintended consequences.
To do what, though? I mean, what needs to be done? I mean,
to do less.
To do less.
But the Fed by law is supposed to see to a stable price level. Well, under QE2, it has overseen the measured rate of inflation going from 1 something to 3 something. Yes. Okay, it is supposed to help us achieve full employment. The unemployment rate is above 9%. Not content with mastering those 2 remits, the Fed has unilaterally chosen a third, which is to raise up asset prices.
To be fair, though, you've had those external shocks. You had Japan, which wasn't accounted for initially by economists, and the tsunami and the impact. You had, uprisings in the Middle East pushing up crude oil. But you're saying, look at the core rate of inflation, period. They're not helping us.
Well, inflation is, of course, a defined term. The Fed defines it very narrowly, but by creating so many dollar bills, new money in the world, the Fed sets, it's like a break ball in a pool game. You don't know exactly where the balls, in which pockets the ball's going to go, but you know that things are changing. The Fed has instituted this vast enterprise called quantitative easing. And the consequences of this are still playing out. The clarifying insight into quantitative easing came in the form of a letter to the editor of the Financial Times about a year ago. The writer says, finally, I think I get it. I get what quantitative easing means. I understand now. What I no longer understand is the meaning of the word money. That is the definitive insight into what this enterprise of QE is all about.
So
debasement.
We had David Blanchflower, Bank of England, formerly of Bank of England, on the show today, and he says we're in a world of competitive quantitative easing. He thinks that the Bank of England is signaling not only more support is coming on the way overseas, but we are going to get QE3 here. What is that?
I'm afraid we are going to get QE3 because the Fed has no intellectual or theoretical ground to deny the possibility of same. So that the Fed intervened because it was afraid the measured rate of inflation would trend below 1 point on wherever it was. So if the measured rate of inflation goes below that, or if the stock market goes down, what's the Fed going to say? This time we're not going to do it? The Fed is now a prisoner of its own, in my opinion, muddled thinking. It's going to be there.
Targeting that inflation rate, you think, would be a bad decision?
Yes, I do, Margaret.
Simply put.
Well, but the Fed was targeting the inflation rate during the it was unofficially targeting the inflation rate during the mid-2000s when the prices of houses were going through the sky, up to the sky, and then if you notice, they came back down to earth. That was an unmeasured inflation problem which the Fed instigated.
Jim Grant, it's always interesting to talk to you.
Well, thank you, Margaret. It's always interesting to be spoken to here.
I was asking for your opinion. Please, and at 12:15, we should be getting more insights. And
getting more words.